Just give a quick introduction. Ms. Shukla is currently spearheading the energy products and strategic initiatives at MCX. She's an experienced fellow chartered accountant and DISA with over 15 years of experience in financial markets across functions like policy research and product management, risk management and compliance, as well as business processes with a wide range of organizations, including regulators, stock exchanges, and banks. She's also worked with various organizations ranging from large financial institutions to new startups and coordinated with other partner organizations in the financial services ecosystem. Ms. Shukla has done securities market law and advanced business analytics from IIM Ahmedabad. Welcome to the conference, Ms. Shukla.
Yeah, thank you so much. At the outset, I would like to thank Powerline for giving us an opportunity to be an exchange partner with them and to be part of this coveted conference they have organized. Just give me a minute to share my presentation, please. MCX, as most of you must be aware, is basically it's a commodity derivatives exchange. First of all, I would just like to give a regulatory disclaimer. I'm today making this presentation. I'm not recommending any specific participation on a specific product. There is no recommendation. It is just an awareness session and just a discussion on a new topic. So MCX is a commodity derivatives exchange, and if you see the regulatory purview which we are now lying is, we come under SEBI regulations, and under them there are stock exchanges, and then just like equity markets, we have members, and through members the clients trade on our platforms. Since SEBI took over the regulatory jurisdiction after post FMC era, there have a lot of developments have taken place in the commodity derivatives markets, with new products coming into picture. Along with futures, options were allowed. The new participations were allowed. Even today, the mutual funds and AIFs have been allowed, and FPIs are in line to be allowed the next in line. Just a moment, I think there's some disturbance. Sorry. So MCX actually holds more than 93% market share, and this has been feasible across with around, we have 600 plus members spread across 1200 cities in India. And a single sign turnaround is on an average, yeah, there have been years which it has been down, but on an average, it is around 28,000 to 30,000 crores a day. On MCX, we have 4 different segments. It's bullion, energy, base metals. In agri, we have few commodities, and then we also have index futures. In energy sector, we currently have crude oil and natural gas. And why we are participating today in this coal-based conference is because our next in line product is electricity futures. As we all know, in India, coal is the major source of electricity generation in Indian markets till date. So in keeping in line with the new product, we are participating in this. So what does an exchange traded platform bring to the market? Basically, we have a standardized contracts. It brings in an efficient price discovery mechanism. And today, the electricity futures, what it bring for the coal-based power generators is, or any value chain participants in the electricity, will be the price risk management. As I was just listening to our speaker prior to me, so yes, there is a price risk because your cost varies with the cost of the raw material, which is the coal, in most of the participants who are participating to attendees today's conference. So with the increase in the price of the coal, we see increase in the cost of generation. However, I don't see there's nothing like we can in this competitive world. We have a entirely 100% pass-through mechanism. So definitely there is a risk. There is a price risk. And in order to maintain our profitability or our margin percentages, this needs to be hedged. This price risk needs to be managed through hedging, which you can efficiently do through commodity derivatives platform. We have in line our electricity futures, the proposals, the joint working group between SEBI and the Central Electricity Regulatory Commission is working on that proposal. So post that product will be available to the market. Now, these markets, when you participate on these markets, these are extensive risk management and surveillance mechanisms are in place. So these are safer markets, standardized markets. In terms of risk management, there is a practice of initial margin, which is a span-based margin. We have ELM, then additional special margins in case of high volatility or certain kind of a fundamental shift in those underlying products. So then these markets, then these additional margins are pulled into picture. There are several other risk management mitigation measures. Now, as most of are aware, derivative markets are mark to market on daily basis. So on this, the mark to market loss monitoring is on real time online basis, and at different levels, the alerts are generated and sent to the market. We have daily price limits, yes, and self match, like buy leg and sell leg between the same entity is being checked. In fact, it's a system based check, so the order entry is not allowed at that level itself. So I'm talking of these measures because just to give you an overview how an exchange mechanism operates, and later we come to the need why now electricity futures will become a need for participation for the participants in this conference. Yes, so now we know this is the Indian electricity market structure. Besides me, I think all the participants here are more aware of these markets rather than me. Around like about a year, me and my team are together working to understand the physical market structure. What we have got is the major outcome is from a long term, there is a shift to the short term. Like we see over more than a decade, there's a shift from say 94% to nearly 88% reduced in long-term PPAs, and accordingly, yes, the short-term market is has increased from 6 to nearly 12%. And within this short-term also, exchange traded market, the spot power exchanges like IEX and PXIL, the participation is increasing. Now, the basic purpose is that means, yes, why the shift is happening is markets are feeling the utility of efficient prices in the short term. They have seen efficient prices in the short term markets and hence the shift. Now, since this is a long term to the short term shift, again, there arises a need when you're moving to these markets. Short-term markets, you have an uncertainty of prices. So you need an instrument, a standardized instrument for managing your price risk. Again, this is just indicating within the exchanges, yes, these are the products which are currently available on the spot platforms, which most of the participants today must be utilizing for their short-term needs. In October 2021, this is a common news, like every year, every time something lately, it has been in October 21, you will say coal stock crunch at thermal plants. Some of the thermal plants are shutting down. The coal from Indonesian markets the imports have reduced, or there's a shortage of imports. So the shortage of power is being witnessed. So all these things, the coal prices reaching unprecedented $200 per ton. Again, all these news are very common every year, though they may be in some proportion and in some months. Most of the time it is happening in October or February times. So why is this? Now, this generates the need. When you're facing such such a variation of the prices in your raw material cost, definitely your further revenue generations or your profit margins are going to be impacted, because as we understand in electricity markets, to certain extent there is a pass-through mechanism, but yes, there are other sectors like agri markets, residential markets. Finally, the entire 100% pass-through is not possible at all. Hence, again, the need, how can we manage this price risk? This price risk can be managed through which the proposal is on anytime, like probably in next financial year, electricity futures will be trading on the MCX platform, subject to the regulatory approvals. And that is actually when we are engaging with one-to-one, we have engaged with lot of generators, discoms, as well as end consumers, and then we have felt the market is feeling the need for a product now to hedge their prices, which is, I will run through some slides. Globally, it is a general practice. Globally, this practice of hedging has been in electricity has been existing for more than a decade now. Outcome of this news, if we see what was the outcome of this news, now these are the prices on the spot exchange of the electricity power. So we see when these news were coming, September, October, we can literally see the spikes. If we see the prices are around say 3,000 per megawatt hour, and we are going as high as 9,000 megawatt hours. 9,000 per megawatt hours. So that's a kind of a variation when we see. Whenever these variations, such spikes are there, it's best we hedge our products and we don't let our profit margins or the bottom lines to be hit in the company. This is for 2018. And again, I'll just show you in 2019, you see the same kind of spikes, which even almost touched 10,000 per megawatt hour. This entirely because there was a raw material. Basically, we have 70% markets from thermal power generation. So the imported coal had unprecedented prices. There was shortage of domestic coal. Ultimately, some thermal plants were being shut down, and the electricity prices on the spot have gone as high as 10,000. But the trades have happened at this price. So when that means if at this price also there are buyers, there are sellers existing, because at the end of the day, power cannot be stored. So if it is generated, it has to be consumed. On the other leg, when the buyer is there, they still buy at this cost because they have to keep the plants running. They have to keep the plants running. So there is a need even at this high price. So on the other hand, if you are doing it at this high price, you are ultimately not only the generators I see for the coal, yes, it's a generator Gencos, but at the end consumer, he's buying at 10,000. So when he's buying at 10,000, whatever manufacturing unit or whatever he's having, his cost of production is increasing to that extent. So it makes sense for him also to hedge his price risk through electricity futures. This is just an indication of over last 5 years, average daily volatility or the min-max average prices which we observe in the spot markets. So we see on an average, it is nowhere between 12 to 15% if you see the average daily volatility. That's the kind of a risk we are exposing to. Always you would have seen most of the companies or the participants who are in the conference today, if any of their companies is exposed to say currency risk, I'm sure most of them will be to the forex risk. But yes, if you are exposed, what it means is the company is hedging their forex risk. And forex risk of last 5 years, if we see, the average daily it's never gone beyond 5%. 4 to 5% is a general norm. And here we are looking around 15%, and 21 was hit it at 17%. So it really makes sense what kind of exposure what kind of a risk we are exposing ourselves to, and what kind of a risk which is being kept open in the market, open for us, which is directly hitting our profitability of the companies. Just to give an example, since it's a coal-based conference, so I'm just giving an example of a generation company. Now, suppose a generation company had entered into a PPA. Now, I don't see ki, even if you have entered into PPAs, still there is a risk which you can hedge. Now, they had entered into a PPA for giving delivery of say 100 megawatt hours at around 4,500 per megawatt hour from next February onwards. Now, what happened is when they enter into this contract, suppose the electricity futures contracts were existing at that time. In the spot, the price is at 4,500, while futures, because there's a cost of capital and the time span. So futures, suppose the price is at 5,000 per megawatt hour. So what this company does is, since they've entered into contract at 4,500, they also go and buy, they lock these prices, they buy electricity futures contract at 5,000 per megawatt hour for the period during which they are going to supply. They have to match the period of supply and the pricing. Now, they supplied during the entire period, and in 28th Feb, their contract closes down. Now, at that time, the prices suppose in the spot market was 6,000, while futures prices were 6,500. Just foresee if there was no futures market, what is happening today? This company is supplying at 4,500 because they've already entered into a contract. But wherein the actual prices during that period have gone as high as 6,000. We may say this is not a loss to the company because, okay, they have factored in cost plus margins, which is 4,500. But in this competitive market, if your competitor is going to sell the electricity at 6,000, you're still at 4,500. There is a notional loss. There is a notional loss. This company, since it was 100 megawatt hours, say around 1,50,000 notional loss. Had it there been no futures markets. But since the company had locked in futures, they closed down that position at 6,500. In derivatives market, they make a savings due to hedging of 1,50,000. So net to net, there is a nil effect. Otherwise, he has opened himself to a notional loss of 1,50,000. Hedging basically is a zero-sum game. It's basically like when we go and take an insurance. Yes, we pay a premium. Premium is a cost for that insurance, but insurance is for actually taking into account certain uncertainty in our lives. We take insurance for our lives. So in similar way, the hedging basically is a zero-sum game. What needs to be looked into? You may have a profit in the spot market and loss in the derivatives market, but the net impact on your profitability or P&L accounts will be either zero or a little profit or a little loss. On the other hand, you may have loss in the spot market like this, but profit in the derivatives market. So it may be a nil effect or zero. So basically what we are doing is we are reducing the bandwidth of the losses which may affect us in the long run. We are reducing that bandwidth to either zero or little plus or minus. That is the impact of the hedging. Now, as just to show these potential benefits in this will exist at every level of the value chain. Whether I take a Genco just showed in the example, Discoms, yes, Discoms are buying from one leg, they have to meet the demand at the other leg, and in between, yes, they also can lock in the prices and benefit from this futures market. Open access consumers, they definitely cannot pass through the entire increase in the cost of productions or cost of raw material. Power, in fact, is part of the cost of production only for any manufacturing unit or any commercial unit also. They cannot pass through the entire thing to the final consumer. It is a highly competitive market these days. So what best is to manage their cost of production, which is through hedging the price risk. Financial investors, yes, in any commodity, in any market, derivatives market, they can not only be the value chain participants because the risk does not go out of the market. Now, value chain is going to manage the risk, but this risk is being taken by the financial investor or what we call as arbitrageurs or speculators. So they take the risk, they take care of this opportunity. Value chain is risk averse and they are risk takers. Risk does not go out of the market anyway. Just in short, quickly running through if you really, if the companies decide, yes, I want to hedge. So what is the life cycle of hedging? What the company will adopt is, now the management first needs to understand a company doesn't always hedge 100% of the risk. There is always a certain component of the risk, a risk appetite, which the company is ready to absorb, because there's a cost. So cost benefit is to be taken into account. Certain, say, out of say 100% of the risk, company decides, yes, 60% I can absorb. So risk 60% is my risk appetite. So that can be absorbed. 40% is what I'm going to hedge. Once these decisions are taken at the management level, then a strategy is formed. So what products you are going to use? Strategy will also involve 4 stages basically. You identify what kind of a risk, what kind of an underlying commodity. Now in this, if there is a generator, a coal-based thermal, the coal is the major thing. And then finally their PPAs, the pricing at which they are going to sell. So the risk exposure identification is there, then consolidation is there. Consolidation basically means a company may be a vertically integrated company. So one leg, like they are buying, say like a discom, they are buying in and selling out. So then you obviously will consolidate your risk, aggregate your risk, and only the final net effect is hedged, because ultimately it's at the group level you decide your risk management strategy. Then it's a hedge. You transact. You have already made a decision, so you make a transaction, hedging transaction on, say, you utilize electricity derivatives over here. Then obviously nothing, a cycle never ends once you analyze what your actual performance has been. There may be times you have to evaluate whether you need to hedge more, hedge less, what is the time you need to exit, because the timing and the quantum has to be matched to the exposure, to your exposure to the actual physical market. So that's a kind of a risk management life cycle a company will adopt once they go forward to hedging.
2-3 minutes more, Ms. Shukla.
Yeah. So this is a very good thing. Even the regulators, now SEBI recognized the need. Like I said, Forex was always there. Companies, all listed companies have been providing the Forex risk disclosures in their annual reports. But commodity risk, which is a much huge risk, was never into picture. But SEBI has amended the LODR regulations, and now this is the table. This is the table which every listed company has to provide in their annual reports under the corporate governance section. Now, this provides what are the commodities that companies is exposed to, what kind of a risk quantified, whether they keep it open, and whether do they hedge. And if they are hedging, which markets or which products they are using for hedging. Now, this is a very good information even to the investor, because investor will understand, suppose this company, I can take again an example, is a coal based, and this company is keeping its entire risk open, and suppose this company is procuring more imported coal than and is not in the subsidized regime. So an investor is not going to hedge in that kind of a company, purchase the shares of that kind of a company, because they know, yes, this company shares can move hayward. In fact, any policies change, trade policies change, or there's a shortage of the imported coal, because they don't have a backup or they do not have hedge. So that's a regulatory decision which SEBI has taken up. Just a quick run through global markets. As I said, this is a global norm across the globe. Now, with the black background are the power spot exchanges, and with the white background are the derivatives or the futures exchanges of this power market. So in US, we have different like PGM, Casio, NYSEO. Those are the spot RTOs. They provide the underlying for the derivatives which are listed on CM, NYMEX, ICE. These are the exchanges. Europe has the EPX spot and the Nord Pool spot. Here the country-wise spot contracts are listed, and EX, European Energy Exchange, provides you a platform for hedging these spot prices. If we go to Singapore, again, there is an exchange. Australia, the only link missing in Indian markets is we have a running spot. There is a shift from the long term to spot. We are the third largest producer consumer of electricity, but we do not have any future derivatives, which ultimately, after a prolonged case in the Supreme Court, now finally it is under the purview of SEBI, and we are going to see the launch of electricity futures soon. This is just at various types of contracts which exist in the market, because on these global practices norms only we are also proposing to introduce our contracts. They have base load, peak load contracts. Now these markets are well developed, so they even have day, night, and they have a longer tenure, running as high as 1 year contracts as well, because these markets are really well developed markets. The contract which we are proposing is, most of you must be participating on IEX or PXIL for your spot electricity needs. So MCX has entered into a licensing agreement with IEX. So our underlying is going to be the IEX day-ahead market MCP price. Price quote is going to be again rupees per megawatt hour, excluding all taxes. Now trading unit, depending on the number of days, because it's a round the clock or the base load contract, monthly futures we are proposing. So it is going to change. So minimum we have kept, say it's a 30-day month, so it will be a 72. So one lot size will be 72 megawatt hours. Tick size is rupees 1 per megawatt hour. Now these are proposed to be cash settled contract. So your physical market continues as is basis, whatever your needs are. You're coming to the futures market only to hedge your price risk. So these are to be cash settled contracts. We are proposing a monthly contract.
Last 1 minute.
Yes. So I'm reaching the slide. Thank you so much. You may just get in touch with me on these points if anyone is interested to understand further. I'm sure most of the participants of this conference have a certain kind of an exposure to the market, and they are feeling the need of electricity futures. So you may kindly get in touch with us. We'll be more than happy to have a discussion with you and your team anytime. Thank you so much.